Well, good afternoon. Thank you very much for joining us today for Bartlett's 2024 strategy update. This is our 11th strategy update. We started doing these in 2014, and we're very, very grateful for your interest. We have over 250 attendees registered for today's session, and I think we have a very, very good update for you. By way of introduction, I'm Jim Hagerty, the CEO of Bartlett Wealth Management, and I'll take a minute to introduce a marvelous panel. Holly Mazzocca, our president, will moderate today's discussion, featuring three terrific people. Jason Katz, a wealth advisor who focuses on financial planning and wealth management. Justin Ellis, a wealth advisor who focuses on investments, and John Finkler, who is the head of our fixed income services. John's a newcomer to Bartlett, just recently joined us after a fine 19-year tenure at Fifth Third Bank, where he managed fixed income, and we recruited him away. So an excellent panel that will be moderated by Holly Mazzocca. I'm going to start with just a brief update on the company. I'm very happy to tell you that 2024 has been another very good year for Bartlett. One of my favorite metrics is that we are tracking at greater than 98% client retention for the year. We measure client retention assiduously. We update it monthly. All of our advisors are tracked, and in fact, incentive compensation here at the company is dictated to a great degree by client retention. So tracking in excess of 98% and adding many new clients this year. In fact, a record year for new client additions. We've had some nice recognition, as you see on the screen. My favorite is in the middle. I think for my entire career, I've been a Barron's subscriber. And so it's very gratifying to me that we were named to their list of the top 100 registered investment advisors in the country. I believe it's our fourth consecutive year on their top 100 list. We came in at 49th, and we intend to keep climbing. So really, really nice recognition for the company. This is very gratifying to us, these statistics, client retention, new business, recognition. It's very gratifying to us. I should say I think it's very important for you too, as clients and advocates, to know that we are a very healthy firm. And one manifestation of that is that in the last year, we've hired across the organization 12 new professionals. This would be in Cincinnati, Chicago, and Louisville, our three offices, 12 new professionals. And that speaks to a firm that's very healthy and investing in its future. Now, in August of this year, we had an annual retreat. We actually turned that word around and call it an advance. We're advancing rather than retreating. This is a 2-day session that we hold here in Cincinnati, where everyone attends from all three offices for 2 days of celebrating our successes, working on any weaknesses, making strategic plans for continued growth and client retention, and also some fun. And so on the screen, you see that we, at our annual dinner, we had some nice recognition of employees with significant anniversaries. We also recognized our receptionist, Pam Wilner. When you get off the elevator at the 21st floor of our building, very first person you see is Pam Wilner, our receptionist. And what a great way to be introduced to Bartlett. She's just a terrific person, terrific team player, and she was the overwhelming choice for the 2024 Bartlett Heart Award recipient. Just a terrific person, Pam Wilner. So a very, very nice year, and we're not resting on our laurels. We're not complacent. We're planning for continued growth, and it's my privilege to share all this good news, and I'm happy to do so. I'm even happier to step aside now and let Holly take over moderating the panel discussion. So thank you again for attending today.
Thank you, Jim, for those fantastic welcoming remarks, and thank you to all of you for joining us here today. As we kick off today's conversation, wanted to share a few logistical items with you. For those of you joining live with us today, please utilize that Q&A box down at the bottom. Add those questions along the way. We're going to leave plenty of time at the end of the conversation for responses on those. And if we don't get to every question today, our team will follow up with you on those items. As we started planning for this year's conversation, we thought back to our conversation with all of you last year. And our theme for 2023 was navigating a changing world. And the conversation we talked about really covered three key items. We talked about changes in artificial intelligence. We spoke about this idea of an elevated interest rate environment and how it was impacting individuals and businesses. And we also talked about potential tax code changes coming up on the horizon. And as we gathered to plan for today's event, all of those changes are still top of mind for us. In fact, our panelists today will cover a number of those topics. We shifted our perspective, though, to really think about a more grounded insight. This year's conversation is all about how we think about those changes that may be coming and build a grounded perspective that allows us to navigate what may lie ahead. In this business, it's important that we think about those principles that are timeless, that are tried and true. We call these our same as ever principles. We also think about all those things that will continue to change along the journey. In fact, that first same as ever principle is in fact the idea that the pace of change will continue to accelerate. Today, our panelists are going to walk through how you can build a really balanced and grounded plan that certainly doesn't overlook the changes ahead, but helps maintain a steady approach along the way. Jason Katz is going to kick us off with a description of how the financial planning process works and how it's evolved over time to help navigate the decisions that come along with potential changes. Jason's also going to jump back in at the end of the conversation to provide us an update on some of those tax items, especially in light of our recent elections. Justin will provide an update on the investment theme of artificial intelligence, and he's going to share a bit more about how to capture a theme like this that is constantly evolving while maintaining that grounded approach. And finally, John Finkler is going to provide an update on where we stand in the economy, how this impacts the Federal Reserve's interest rate policy, and how investors can build a very solid investment strategy, especially on the bond side of their portfolios. So with that, Jason, you're up first. Let's kick it off with the topic of financial planning and how it's evolved over time. When you think about the idea of a grounded perspective, what does it mean in the financial planning world?
Well, the financial planning work that we do with our clients is designed to keep us all grounded. It's no mistake that we're starting today's presentation talking about financial planning because that is typically how our conversations with our clients start. They come in with questions like, when can I retire? Or will I have enough money to sustain me through my lifetime? Or even, can I make that large charitable contribution this year and still have enough money to achieve all my other goals, including my legacy goals? And our process is designed to answer all of those questions, but our ultimate goal is to establish and build a foundation and a framework that keeps us grounded in any market condition. We consistently experience that our clients who engage in financial planning have lower levels of worry in down markets, while also having lower levels of jubilation in great markets. They have the confidence to use the financial plan as a decision-making tool for all the big financial decisions. So they have the peace of mind to make that large charitable contribution or to make that gift to a family member when they need it most. Now, here's a quote from Benjamin Franklin that I've loved long before I became a financial planner. If you fail to plan, you're planning to fail. And as I say those words out loud, the image that comes to mind are my two kids and their collective eye rolls. But we do believe that intentional planning leads to greater outcomes for our clients.
Jason, how has this process evolved over time?
So the fundamentals of a solid financial plan really haven't changed. Those are some of those same as ever types of things. Things like save like a pessimist and invest like an optimist. Choose preparation over prediction, or even know your why and what success looks like for you and your family. But the way that we do financial planning has evolved in many ways. In the past, we would print out reports and page through those with you, and that would be your plan. Now, the issue with that approach is that it's static in nature, and the moment that we press print, the numbers are already out of date. Now, our process is much more dynamic, where we're building a model and layering different what-if scenarios to stress test it in different market environments. Now, for those of you who've engaged in financial planning with us, this screen will look familiar. Right in the middle of the screen, you'll see an 86% success rate. So when we ran this particular financial plan 1,000 different times in 1,000 different market scenarios, 86% of them were successful. You'll also see on the left side of your screen some of those what-if scenarios that we build out with clients and customize to their plan. And this is something that we do at the outset of engagement, but also something that we update at least annually, and especially when there's a big financial decision looming. We've also expanded the tools that we use in our financial planning process to include ones that dive deeper on Social Security planning, as well as income tax planning. We've also developed a tool that helps our clients identify and document their values and really understand the purpose of their wealth. And finally, the actual planning that we do for our clients has continued to deepen. We're helping clients with their legacy planning and also diving deep with our business owner clients in their business succession planning efforts.
So, Jason, you have this financial plan now. How does this process lead into the investment work the team does?
A client's financial plan is the foundation that their investment policy is built upon. The plan lays out the cash flow needs of a client over a long period of time, which helps us identify how much a client needs to have in safe assets to achieve those short-term cash needs, and how much risk they need to take in the portfolio to achieve those long-term goals. And it's this plan, along with an intentional conversation around a client's willingness to take risk, that leads us to the appropriate asset allocation for each of the portfolios. So it's at this point that we as planners partner with our investment team. So for example, Justin on the equity side and John on the bond side, to build that investment policy statement. And that's a statement that will guide us through in terms of how they construct the portfolio, considering things such as risk, taxes, and diversification.
Great. So now that we've seen how this financial plan really helps create a grounded perspective to deal with the changes ahead, Justin, I want to bring you in to talk about one of those areas that's continuing to evolve, and that's the topic of artificial intelligence. How can investors maintain a grounded perspective while still taking advantage of an investment opportunity that's evolving, like artificial intelligence?
Last year, my colleague Matt Stiff walked us through the history of artificial intelligence and discussed the current excitement and tremendous opportunity that the technology presents. We shared with you how this excitement is exemplified by how quickly AI applications like ChatGPT have been adopted by users, a pace faster than any other popular technology application. Another way to measure this excitement is to follow the money. The headlines you see here are all from just the last 4 months, and new ones are written daily. Money talks, and it's clearly telling us that the biggest companies in the world agree that there is something to be excited about. In their second quarter earnings updates, it was reported that Amazon, Microsoft, and Alphabet, the parent company of Google, all invested in artificial intelligence and all spent more than they originally expected to. These key players in the industry have been labeled hyperscalers because they are large cloud computing companies that also own and operate their own data centers, which enable them to house and operate AI workloads. As you can see from this chart, there's been a huge increase in investment by this group from 2023 to 2024. And we estimate that this trend will continue through at least 2026. This spending is necessary to stay competitive with state-of-the-art hardware and increased server capacity so they can continue to train and run their AI models.
So Justin, based on this chart and second quarter earnings, third quarter earnings, what they're continuing to tell us is coming down the pipe for 2025, it's evident that these large hyperscalers are spending a heck of a lot of money on this investment space. Is there a risk of overspending on artificial intelligence?
Well, it certainly doesn't seem that corporations believe there is. In their second quarter earnings report, Alphabet CEO Sundar Pichai responded to questions of the multi-trillion-dollar company's capital expenditure numbers in AI by saying he believes the risk of underinvesting is dramatically greater than the risk of overinvesting. But we wanted to put this spending into perspective for you. So here we're sharing the total capital expenditures and research and development costs as a percentage of cash flow from operations for the information technology and communication services sectors, as well as Amazon. And it's clear in relative terms, the current level of spending is not extreme. We're nowhere near the level seen during previous tech innovation cycles, like the large increase you see leading up to the dot-com crash. This is primarily true because the main players that we think about today in the AI space are mature companies who have consistent, proven businesses, which were born out of previous innovation cycles.
So let's dig in a little deeper on that idea of this innovation cycle. When you think about this current trend, where do you think we are in the innovation and investment cycle for AI?
Well, we created this next chart to give a visual representation of where we may be in the cycle. First, we plotted the capital investment line, which begins low but increases very quickly with time. And as we've laid out, we are well on our way here. Next, much later in the cycle, revenue begins to materialize. As we speak today, revenue from AI applications is minimal. The last line in blue represents perceived risk. While risk is high at the beginning of the cycle, the excitement around the new technology overshadows it. As time goes on and investment continues, impatience sets in, the excitement wanes, but the risk remains until revenue materializes. Now, it's difficult to say exactly where we are in this cycle, but we estimate we're somewhere here in this shaded area. We're still very early in the cycle with investment accelerating, risk high, and there's little revenue to speak of. But I think that's an important point to reiterate. We really do think that we're still in the early stages of the growth phase of this technology cycle. But we expect to get some more information next year and in 2026 as these companies begin to project what revenue might look like from their AI products.
So Justin, as we look at this chart and we see that investment size continuing to accelerate and all this spending that's going into it, what does a positive return on investment really look like? Can you help us quantify what would be required of that orange revenue line for this to be deemed a success?
Based on the total estimated capital expenditures through the end of 2024, so for this calendar year, there are estimates that there needs to be an additional $600 billion in increased revenue per year from AI applications in order to make the return on the investment in AI worthwhile. Now, this is just an estimate, but if this figure is eventually realized, not only will the current investment pay off, but it also means that generative AI has become the significant innovation we all expect it to be. Now, is AI the best thing since sliced bread? I would venture to guess that's not the case for most of us at this point in time. I know I personally experienced more efficiency gains by not having to slice the bread for my kid's grilled cheese sandwich than I do for any generative AI-powered application. But there may come a day where we take for granted the power of artificial intelligence, just as we do when we open a loaf of bread. Now, investors who have the appropriate temperament and long-term time horizon will certainly benefit from investing in this theme. And as clients, you are invested in companies who are investing in this space, both as hyperscalers, but also as future customers who will be utilizing these products and technologies to modernize or create efficiencies in their own businesses.
Justin, let me know when AI can start making my daughter's peanut butter and jelly sandwich for her lunchbox every day, because then that would be real efficiencies in the Mazzocca household.
Exactly.
So we talk about all these benefits. Companies are excited about the benefits. We don't always talk about the obstacles and the risks that are out there. What obstacles could hinder the long-term success of artificial intelligence?
Longer term, there are at least two obstacles that will need to be overcome, including regulation and the electricity demand. At the moment, there is little regulation around AI processes and output. For instance, if you enter a prompt into ChatGPT and receive a response, do you have ownership of that creation, or does the AI software company own it? Regulation is important to draw clear lines and protect intellectual property. But the same can be said for protecting consumers and their data. Dialoguing with AI programs is not a private conversation between friends. So consider this your public service announcement to never input your protected personal information into an AI prompt. But as this technology continues to rapidly evolve and becoming more capable, creating a regulatory framework will become simultaneously more difficult and more imperative. The second obstacle that will need to be overcome is the electricity requirement, the demand for electricity that is required with AI. And so, as you can see in this chart, we've experienced a boom in compute instances since 2019, which is a reflection of the growth in the number of AI models as well as the capability of those models. So as AI continues to grow, so does the electricity demand. So we wanted to put this demand into perspective for you. So in 2023, Meta, the parent company of Facebook, utilized an equivalent amount of power in its data centers that is required to power 1.4 million homes. So that means that Meta consumed as much power as all the households in a city roughly the size of Chicago. The available supply of electricity from our grid is certainly an issue that corporations are going to have to overcome, and obviously has other implications for you and me. But you may have seen in the news recently that the owner of the dormant 3 Mile Island nuclear plant in Pennsylvania is planning to invest $1.6 billion to revive it. And they have an agreement in place to sell all the output to Microsoft as they seek carbon-free electricity for data centers to power their AI initiatives. Innovation in one area often demands innovation in others, and we're starting to see some of that play out. But the strain on our electrical grid and the regulation around AI are certainly broader trends, and certainly have implications based off of the elections and the priorities from the new administration. And so we're following these themes closely, and you can expect to hear more from us at some point in the future.
And that's something that I think we're going to be talking a lot about as we go forward, is this constant balance between what policy says or policy hopes are versus what real supply and demand is. And I mean, this chart just sort of says it all, that real demand for the electricity grid is coming from artificial intelligence, and it's not going to stop. So more to come on that one. I love that we can look for these ways of really maintaining that grounded perspective, even in an area that's changing as rapidly as artificial intelligence. John, another area of interest that is changing pretty much monthly now at this point is Federal Reserve policy and the resulting impact on interest rates. A lot of our clients are wondering if the Fed can engineer this idea of the soft landing. How does Bartlett maintain a grounded perspective as interest rate policy starts to shift?
Well, the Federal Reserve certainly has its hands full as it attempts to land the economy smoothly while avoiding a recession. I think risks to the economic outlook are higher today than they were 6 months ago, but by no means is a crash landing our base case scenario. I think rather the economic outlook is cautiously optimistic, but certainly as we navigate these potential challenges ahead, vigilance is certainly necessary. And the Fed certainly continues to keep its eye on economic conditions, really aiming to ease policy and lower interest rates over the next couple of years. And I think since the Fed has gotten so much attention lately, I thought it would be good to highlight the Federal Reserve's dual mandate, which is maximum employment and stable inflation. By adjusting short-term interest rates, the Fed can stimulate a sluggish economy or cool down an overheated one by influencing lending and borrowing rates. This recent quote from Jay Powell, the chairman of the Federal Reserve, I thought summed up economic policy quite well. He said, "The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks." So it's evident that the Fed feels the time is right to begin lowering interest rates, but I think the timing and the pace of those cuts is highly uncertain.
So the Federal Reserve is trying to strike this balance between full employment, stable prices. What are the most meaningful aspects of the economic landscape our policymakers are paying attention to as they craft this plan?
So there's a wide range of data that the Federal Reserve is monitoring, but I'll just highlight a few of the key areas. The first is inflation. Inflation impacts everyone in the economy, including workers, businesses, and people on a fixed income. If you remember, it was just a few years ago that inflation peaked at over 9%. Because of the Federal Reserve actions in 2022 and 2023, 1 year ago, inflation was 3.7%. And more recently, it's actually 2.6%. I know this chart shows 2.4, but we had an inflation release just over a week ago. If we look at the underlying components of CPI, most are stable. The one area that continues to put upward pressure on the overall inflation rate is housing or shelter.
What about the employment side of the equation? We've talked a lot about inflation over the past couple of years, and more recently, it seems like the unemployment data is starting to really catch people's eye. Where do we stand on that?
So the unemployment rate is a key indicator of consumer health. The current employment landscape is actually relatively robust, with an unemployment rate of 4.1%, especially when you compare that to historical averages. It's the quick move higher we've seen over the past year from 3.8% to 4.1% that's really caught the eye of the Federal Reserve and certainly has played a role in the recent rate cuts. Now, the significance of a healthy job market to the consumer cannot be understated. So it's reasonable to anticipate the Fed will act quickly to counter further declines in the employment levels.
So inflation is lower, unemployment is up modestly. What are we seeing in terms of real economic growth in the United States?
The gross domestic product, or GDP, really serves as a broad indicator of health and growth. There's many factors to consider when assessing the growth picture, such as consumer spending or government spending, or even the geopolitical tensions, to name a few. With quarter-over-quarter GDP at 3% and showing an encouraging trend higher from a year ago, it's safe to characterize GDP growth as healthy and not signaling signs of an imminent recession.
So, John, you mentioned that one of the items on a lot of people's mind is the impact of housing, as it's a big part of that inflation piece. As we've started to see short-term rates come down modestly and some things start to shift in the economy, are we starting to see some loosening up on the 30-year mortgage rate?
Well, unfortunately, the decline that we've seen in year-over-year Treasury rates has not significantly moved the 30-year mortgage rate to any great degree. Now, it's important to note that there's a multitude of factors that go into setting mortgage rates. It's not simply Treasury rates alone. Now, in addition to rates, supply has also been a big factor in keeping this housing market inflated. These higher mortgage rates have helped freeze existing homeowners. Almost 80% of existing homeowners have mortgages at a rate below 5%. So it's really likely that mortgage rates need to get into that 3 to 4% range to really entice existing homeowners out of their current homes. And barring a complete economic meltdown, which isn't our base case, we're not going back to those low mortgage rates anytime soon.
You've spoken about the importance of the U.S. consumer. How does the U.S. consumer impact this overall economic picture, and how healthy is the consumer right now?
Well, 2/3 of our domestic economy is driven by consumer spending. So a healthy consumer is vital to continued growth. And one way that we can measure the health of the consumer is the personal savings rate. A low savings rate can really leave individuals vulnerable to financial shocks such as job loss. The 20-year average of the personal savings rate as a percent of disposable personal income is 6%. So the trend lower that we've seen over the past year from 5.5 to 4.8% leaves us a little bit more cautious on the US consumer. Now, moving forward, the two biggest threats that we see to the consumer are a resurgence of inflation and employment. Keeping prices down and maintaining a job is essential to a strong consumer.
So, John, when we take this economic dashboard in totality, and the Fed is starting to think about how they can shift policy, what are the real impacts on the interest rates that we all experience?
Well, the Federal Reserve's interest rate policy plays a crucial role in shaping the US Treasury yield curve, which reflects the relationship between interest rates and the maturity of government debt securities. This graph you're seeing represents the current US Treasury yield curve. Now, the highlighted gray area indicates that the Fed directly affects short-term yields. Now, longer-term yields are really driven more by market expectations about future economic conditions and expectations about future Fed policy. Now, these longer-term Treasury rates are really important to you and me because they act as a benchmark for other debts in the market, such as bank lending rates and mortgages.
So, John, where does the Fed think that rates will go from here? What are they telling us they are expecting?
So each quarter, the Federal Reserve publishes their expectations for short-term rates. Traders in both the bond and equity markets closely analyze the forecast and compare current estimates versus previous ones to look for any changes that could indicate shifts in the Fed's stance on interest rates. The shaded area here shows that the Fed expects to continue reducing policy rates over the next few years. Now, a slow, methodical move lower by the Fed would lead to lower short-term yields, while long-term yields remain more unpredictable from here.
So, John, there's one question we hear every year from our audience. And in fact, it was the very first question that popped up on our Q&A here today. So I'm glad that we can address this head on. Let's talk a little bit about the US deficit and the total government debt. What are your thoughts, and how do we address this concern about the large size of the US government debt?
So I heard this great quote from David Rubenstein just last week, and he's the founder of a private equity firm on the East Coast. And he said that the debt and the deficit is like the weather. Everybody likes to talk about it. Everybody has an opinion on it, but no one is able to do anything about it. So to kind of set the tone here for where we stand with the current debt and the deficit, according to the most recent data from the Congressional Budget Office, the U.S. has $35 trillion in debt outstanding. The U.S. government continues to add to this debt, resulting in a $1.8 trillion deficit in the current fiscal year, which represents over 6% of GDP. Now, the interest expense alone on America's debt now exceeds our defense budget, and soon it will also exceed Medicare. So this persistent deficit and high levels of debt are really a dark shadow over our markets. And one of the concerns that we have is that a rising deficit can really alarm investors about the government's ability to manage its debt, which might lead them to require higher interest rates to compensate for the added risk. Now, any upward pressure that we see on rates would make it more expensive for individuals to borrow money, and this can ultimately impact the long-term growth of our country. Now, sustaining such a large deficit while the unemployment rate is at multi-decade lows is unprecedented. Consider the recessions of the 70s and the 80s. The US was in a very similar fiscal situation as it is today, yet the unemployment rate in each of those time periods was nearly double what it is today. So today's low unemployment rate really supports a strong consumer who ultimately continues to spend and really encourages modest growth, which should help narrow the deficit. Now, I realize that this is not the rosiest of pictures here, but if we can look a little bit more forward, the path to reducing the deficit can go a few different directions. The first of which is to grow our way out of it. The spending that we have today on the infrastructure, education, job growth, to name a few, can really drive economic growth in the future. Now, second, this new administration, which will be in office in less than 2 months, potentially could they find ways to cut spending? And finally, the potential for increased revenue via tax reform could help. And I'll let Jason touch on that whole piece here in just a few minutes.
Great. Well, thank you, John, for tackling that one head on. The new guy on the team always gets the hardest questions. So thanks for being a true team player on that one. Now that we've seen how this interest rate landscape is continuing to evolve and how you can maintain a grounded perspective as it continues to shift, Justin, I want to bring you back in here to talk about an experience in the market on the equity side. Last year, we spent some significant time talking about the Magnificent Seven and how the equity market returns were pretty concentrated in a limited number of U.S. large cap stocks. Is this a trend that we've continued to see, or has this started to shift?
Well, as we reviewed last year, market returns have been attributed to just a few companies, many of which are direct suppliers of or beneficiaries to this artificial intelligence trend. But this year, with the recent changes in investor sentiment around corporations spending on artificial intelligence that I discussed, as well as the gradual change in economic activity that John just touched on, we've witnessed a shift away from a rally in a few concentrated stocks to a more broad-based market rally. And this chart here exemplifies this shift. Here we're comparing the relative performance of the S&P 500 market-weighted index to that of the S&P 500 equal-weighted index. Now, the takeaway for this chart is that when the line goes down, there's generally less concentration and more breadth in market advancements. As you can see, the line was moving up all of last year, while this year we've seen the line moving down. It's important to point out that both years have seen solid stock market returns, but the driver of market returns in 2024 has been less reliant on just a few concentrated stocks.
What is driving this change toward a broader market rally?
There are 3 key market changes that we've been monitoring that are driving this shift to a broader market. The first being an increase in number of companies expected to grow their earnings. The second being better earnings growth for the broader market relative to the more concentrated Magnificent Seven stocks. And the third being the change in interest rate policy. First, there are more companies expected to grow their earnings compared to this time last year. And this chart shows the percentage of companies in the S&P 500 with a positive 12-month change in expected future earnings. Now, we recognize that this is a bit of a busy chart, so we want to focus your attention to the portion of the blue line that we've circled, which shows that the percentage of companies growing their earnings has increased significantly, up from about 55% of companies in 2023 to around 75% at current levels. The second reason for more market breadth is that earnings growth expectations for the broader market have improved in absolute terms, and the earnings growth expectations for the Magnificent Seven stocks have come back down to earth. As a refresher from our conversation last year, Magnificent Seven is the nickname created to group the companies Apple, Amazon, Alphabet, Meta, NVIDIA, and Tesla. As you can see from this chart, there was a massive earnings growth gap between the Magnificent Seven and the broader market in 2024. In 2025, the expectation is for this gap to narrow significantly. The third reason for more market breadth is due to change in interest rate policy that John discussed earlier. As the Federal Reserve changes its process of reducing short-term interest rates, moving to a more accommodative interest rate policy, we also see an impact on an equity investor appetite and expectations. So this next chart compares the average equity sector performance 6 months after the Federal Reserve's first interest rate cut during the last 4 cycles. Utilities, consumer staples, and healthcare sectors are historically have been categorized as having defensive characteristics. And as you can see, in the last 4 Federal Reserve policy cycles, they were the 3 best performing sectors 6 months after that first interest rate cut. For comparison, these sectors were 3 of the 4 worst performing sectors in 2023 when we experienced a more concentrated market. Now, it's important to point out that no 2 cycles are the same. And in fact, the last 4 cycles were in response to very large economic events, which is in stark contrast to today.
So Justin, with these market dynamics continuing to evolve, how do investors maintain a grounded perspective?
Well, we've been fortunate to have a few consecutive calendar years of excellent stock market returns. Just this year alone, we've witnessed more than 50 record closes for the S&P 500. And while we are certainly grateful, we are not complacent. We recognize that this environment is a perfect reminder of the importance of reviewing our client investment allocations and, where appropriate, rebalancing both our equity and fixed income portfolios. Allocations and inherent portfolio risks will have shifted in set it and forget it and non-professionally managed portfolios. For example, a 50% stock and a 50% bond portfolio at the beginning of 2023 would look closer to a 58% stock, 42% bond portfolio as of September 30th of this year. Now, for some clients, this may be an acceptable or even welcome change, but in that case, it's prudent for us to update our investment policy statements to reflect this increase in risk tolerance. For others, it's been a great opportunity to take market gains off the table and rebalance to more appropriate long-term allocation targets.
So Justin, it's important that we're proactive when markets are really strong to rebalance along the way, to really go back to that asset allocation and make sure that we're not becoming complacent on it ahead of stock market volatility, right? So what would history tell us is normal to expect for stock market volatility, which we know is inevitable at some point?
Yeah, what we do know is that short-term volatility is kind of the price of admission for long-term growth. And while unpleasant, market swoons are an inevitable part of the investment landscape. As you can see from this chart, historically, we've experienced a 5% decline multiple times a year, a 10% decline once a year, and a full-blown bear market 20% decline or greater every 3 or 4 years. And as investment managers, we recognize the follies of attempting to predict the unpredictable, like when the next correction or bear market may occur. Instead, we choose to prepare for the inevitable. The great investor Peter Lynch once said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves.
So Justin, when we hit these inevitable bumps in the road, it is often natural for investors to say, hey, it's been a good run. There's a lot of uncertainty out there in the world today. Let me just sit this one out until things calm down a little bit. What risk is there to this short-term strategy?
It's a natural emotional reaction to want to sell out of the market, seeking safety in cash or other assets during extreme market declines. But the reality is that the result of doing this can be devastating to wealth creation and the goals and desired outcomes set forth in financial plans. This chart serves as a reminder and the forewarning of the risks of market timing. Using roughly the last 20 years as a guide, investors who miss just the best 10 market days during that 20-year period see their annualized returns nearly cut in half. It's also interesting to note that many of those 10 best days occurred within just 2 weeks of the 10 worst days, meaning by attempting to miss the worst days, you're often likely to miss the best days as well. Just another example of the impossible nature of timing the market. We are firm believers that the only surefire way to lose out during periods of poor performance is to capitulate, selling assets at depressed values due to improper planning or fear. Investors who are educated on and prepared for the inevitability of volatility are better emotionally equipped and better able to take advantage of the opportunities that these market swoons create to purchase quality companies at discount prices. Long-term investors are rewarded for their ability to withstand the discomfort and trusting in the safeguards embedded in their portfolio constructions and financial plans and benefit from the effects of long-term compounding.
Thank you, Justin, for walking through the details of that and how it's important to both be proactive when things are really great, knowing that that trend won't continue forever, and also to really remain focused on that long-term plan when the inevitable volatility does come along. John, let's take a look at how we can maintain this balanced perspective on the fixed income side of our portfolios. How do you think about the role of bonds as we think about managing through those ups and downs?
Well, while bonds don't carry the return potential of equities, they really serve two purposes in your portfolio. The first is a steady and reliable stream of income that can be both taxable or tax exempt. And the second is diversification. Since no single portfolio allocation is suitable for every situation, I think it's just understanding your potential risks that's really crucial. Consider this graph. From the 1926 to the end of last year, if you were invested in a 100% stock portfolio, your average return over that time period is about 10%. Now, your range of returns is pretty wide, anywhere from positive 54% to negative 43%. Now, on the other end of the spectrum, if you were invested in a 100% bond portfolio over that same time period, your average return gets a lot smaller to about 5%, but so does your range of returns, as you can see from these bars. Now, I'm not suggesting that a 100% stock allocation is incorrect, but I think it's just important to recognize the potential for return volatility in your portfolio. And incorporating some bonds into your portfolio can help reduce that overall portfolio volatility. So let's look at a few noteworthy events in the past 25 years, like the tech bubble in the late 90s, or the financial crisis in 08-09, and more recently, COVID. In each of those time periods, the initial decline in stocks was quite eye-opening, while bonds remained generally resilient. Now, they generally also moved in the opposite direction of stocks. And it's during times like these that investors may need liquidity. And the bond market, in particular the government bonds, really offer the flexibility to trade positions easily, even amid high volatility in other markets.
So, John, over the past couple of years, investors have been comfortable holding a slightly higher allocation to cash, given money market fund rates have been pretty high. If the Federal Reserve is able to continue to bring down short-term rates like they are hoping they can, based on current expectations, how can investors manage through this to still have a positive experience in their overall bond portfolio?
Yeah, so cash has been king over the past few years. Now, our fixed income portfolios are constructed to fulfill the goals of our clients, even as short-term rates decline. Now, to achieve this, the investors will typically align their time horizon with the duration or time to maturity of their bond investments. Now, someone saving for a short-term goal might opt for a shorter duration bond portfolio, while those looking for income over a longer time horizon might choose a longer duration strategy. Now, it's also helpful to understand that fixed income securities are issued by various entities, including municipalities and corporations, and obviously the US government. Now, within these different sectors, each issuer has varying levels of credit risk, impacting yield and ultimately return. So it's really your time to maturity, your sectors, and your credit quality that form the fundamental elements of a fixed income strategy, and together they influence risk, return, and overall performance.
And John, how does the team work together as they're managing these fixed income portfolios?
So at Bartlett, we manage fixed income portfolios for both private clients as well as institutions. We have an in-house fixed income team comprised of 4 portfolio managers and 3 traders. And on average, we have about 25 years in the industry. So you could say we've seen a few different market cycles. Now, the team actively manages a range of strategies, collaborating with our advisors and our planners to create tailored portfolios that meet our clients' needs. For the tax-sensitive investor, we offer several municipal-focused strategies, each with varying degrees of interest rate risk. With the municipal focus, clients in this strategy tend to be individuals or families, and often this can be used as a tax management tool. Now, we also offer a corporate-focused set of strategies. And the typical client here might be your not-for-profit, endowments and foundations, or even the low or non-taxable accounts. Some of you in the audience today may serve on a committee or a board of an organization that could also benefit here. But all of our strategies here at Bartlett are designed to benefit a range of clients by providing tailored solutions that align with your unique financial goals.
And just this morning, I was having conversations with a client about that idea of taking some excess business cash and putting it towards that more limited duration idea as cash rates continue to change. So certainly ever evolving. Jason, I want to go back to you and bring you in here. We had a question from the audience asking about what could happen under President-elect Trump's administration. And one of those areas that has really shifted expectations is how tax policy could be impacted. I'm sort of constantly reminded of this idea of policy versus promises. So let's talk a little bit here about what the policy is today. What are the laws in place today, and how you think these may shift as we look forward?
Yeah, so let me start at a very high level and explain what the TCJA is and what we mean by a sunset. So the Tax Cuts and Jobs Act was passed in 2017, and it drastically changed the way that individuals and businesses are taxed. So generally speaking, taxes came down for many of these taxpayers. But the key thing that is important to know today is that many of those provisions that were passed will sunset on December 31st, 2025. So effectively, what that means that in 2026, many of those tax rules will revert to what they were in 2016. And of course, this is unless Congress acts to extend or change the law in some way. So let me address the couple weeks ago, we had an election. Don't know if you knew that. I'm sure you're appreciating the lack of commercials. The election, as you know, did change the political makeup of both Congress and the presidency. We now have a Republican president-elect, a Republican-controlled Senate with 53 seats, not 60, and a Republican-controlled House of Representatives, albeit with a pretty slim margin. It's also clear that most of the Republicans would like to see most or all of the tax provisions of the TCJA extended well beyond 2026. However, it's important to consider that any change would require legislative action, which hasn't really been a strength of our Congress in the past. It's also important to note that there are many competing priorities in any administration, and we're starting to hear a little more and more about those each day. And a reminder that there are members of Congress who do care deeply about our national debt and the effect of any further tax cuts on those debt levels. So, given all this backdrop, we still think it's important to walk through the potential changes that could happen in 2026, especially because of two reasons. One, it is our current law. And two, any potential extension would likely be a negotiation of some of these provisions. So I think it's important to know what those provisions are. So for this particular scenario, we're going to choose preparation over prediction. And specifically, I'll go into two different areas of the tax law, changes to the estate tax rules, as well as changes to the income tax rules.
Let's kick it off on the estate tax side.
So let me start with the lifetime estate exemption. So the exemption is the amount that a person can give during their life or at their death without any estate taxes paid out of pocket. So here's a table of the estate and gift tax exemption dating back to 1997. So you'll see it was around $600,000 and it's grown to the current level of $13.61 million here in 2024. You can also see the green line, which is the estate tax rate. This is the tax rate that one would pay if your taxable estate is above those exemption levels, and that's stayed steady at 40% over the recent past. You'll also see right in the middle of the chart a blip in 2010, and that's a year that the estate tax was actually eliminated. Many dub this as the George Steinbrenner year, the year that the famous former owner of the New York Yankees passed away and actually paid no estate tax. Now, this next slide will show what is set to happen over the next several years. So you'll see on the left side, the 13.61 million is our current exemption. That is set to go to 13.99 million in 2025. And then you'll see the effect of what a sunset would do on this exemption. So if the sunset were to occur, the exemption would go from about 14 million and cut in half to about $7 million. So as you can see, there would be a lot more of our clients who could have taxable estates if a sunset were to occur and pay effectively a 40% tax.
So Jason, what kind of planning can we do to prepare for this potential?
So I think it depends on, the size of your estate, but I'd split our clients maybe into 3 different segments, and I'll give you some thoughts on each. So the first segment would be the folks on the far left side of your screen, and those would be maybe with clients with less than $7 million in their taxable estate. And frankly, I think these clients have less to worry about in terms of making a large gift to use up their exemption. Now, that doesn't mean that we don't think that estate planning is incredibly important for these people. It's in fact important for everybody on this continuum. So things like titling and beneficiary designations, even gifting, as we'll talk about a little bit later. But overall, a little less urgency on any action before 2026. The second segment that I'll talk about is maybe on the far right side. So those clients with over $50 million in their taxable estate. And the vast majority of these clients we've already been talking to their estate planning attorneys as well about whether they should make a large gift to use up their exemptions. So we're talking to them about how much to give, what kinds of strategies, discounts, and as well as any types of trust that we should create to receive these gifts. And we're seeing a lot of clients gifting assets to a particular type of trust called a SLAT, or a spousal lifetime access trust. And finally, the third segment, those in the middle. So think of clients between maybe that $14 million range and $50 million range. And this is the group that requires the most analysis in order to decide how much to gift. And just remembering that not all of the factors that go into that decision have to do with taxes.
So Jason, let's think about the what kind of planning can be done for any of these 3 segments of clients.
Yeah, so annual exclusion gifting can be a very powerful tool for transferring wealth regardless of the size of your estate. So let's look at a quick example. We have a client here who has 3 children and 3 grandchildren, and they decide to make a full annual exclusion gift of $18,000 to each child and grandchild each year for the next 20 years. So as a reminder, the annual exclusion is the amount that you can give to any person without affecting that exemption that I've been talking about before. So you can see that from the green line that these gifts almost go as high as $5 million, considering a 6% rate of return. So it can be a really powerful way to transfer almost $5 million out of this one's estate. And remember that these gifts do not have to go outright to an individual. So they can be put into a trust and protected for the long term. These gifts can go into a 529 plan and be used for educational expenses, or even a Roth IRA if the recipient has earned income. So also remember that any gift that you give directly to a medical or an educational institution won't even count towards that $18,000 annual exclusion limit.
Jason, let's shift over to look at the income tax side. If Congress doesn't act, how will the income tax rates change?
Yeah, so on the left side of your screen, you'll see the current ordinary income tax marginal rates, and you'll see they range from 10% all the way up to 37%. And on the right side, you'll see what the rates would be in 2026 if a sunset were to occur. And the first thing you'll notice is that the highest marginal rate goes to 39.6. But this really doesn't tell the whole story, because the actual impact is much different whether you're a single taxpayer or a married filing joint taxpayer. So let's look at the single taxpayer first. And you'll see on your screen a graph, and basically the peach colored shading is where the rate is set to go up, whereas that silver colored shading is where the rate is set to go down. So if we target in on a single filer with a taxable income of $300,000, their marginal rate is actually set to go down 2%, from 35% down to 33%. Now, our married filing joint filers are not so lucky. So as you can see, there's a lot of peach colored shading on this graph, indicating that rates would go up, and in some cases pretty significantly. So if we again target that $300,000 of taxable income, the marginal rate is set to go up 9%, from 24% to 33%.
Jason, we talk a lot about marginal rates. How does this differ from the effective rate, and what things should we keep an eye on as we start to hear Congress negotiating likely on some of these tax changes? What things could impact that effective rate?
Yeah, so the marginal rate is the rate that your last dollar of taxable income is taxed at. So we're in a progressive tax system. So if you're in the 37% bracket today, you don't pay 37% on all of your income, just the amount over the income threshold. Whereas the effective tax rate is really the total amount of tax that you pay over your income. So kind of your blended tax rate. And yeah, there are a couple provisions of the TCJA that would sunset that would have an impact on your effective rate. So here are a couple of those, starting with the top left, which is the standard deduction. And if a sunset were to occur, that standard deduction would be cut in half. So for those who take the standard deduction, that means, lower deduction, higher effective tax rate. This also may mean that many more people will be itemizing deductions. So that could also have an impact on your effective rate. Maybe on the other side of the coin, you have the state and local tax cap of $10,000 would be eliminated. So currently, if you add up all of your state and local income and property taxes, you're only able to deduct $10,000 of those on your tax return. This cap would be eliminated. So this would actually have a pretty significant impact on those in higher tax states, Illinois, New York, California, those who pay high property taxes. You'd be able to deduct more of those taxes, which would bring down your effective tax rate in the future. Professional fees would again be deductible if over 2% of your adjusted gross income. So again, the fees that you pay to your favorite wealth advisor could be deductible again in the future. And finally, the QBI deduction, the qualified business income deduction. This is a deduction that many pass-through entity businesses take today, and that lowers their effective rate down in the 20% range. So if there's one particular provision that we have our eye on the most, it's that last one, the QBI deduction, which could effectively increase business owners' tax rates from currently at about 20%. It could go as high as 39.6%.
So Jason, we appreciate that we don't have all the answers on exactly what will likely happen with this sunset of the Tax Cuts and Jobs Act. What actions can people take now to plan, knowing that we may not have all the answers for some time to come?
Yeah, I think it's important to kind of draw back on a couple things I said before in terms of the timing of when these tax changes would have to happen. It would have to happen next year. before 2026. So not a lot of time to figure out which one of these provisions will be extended or even applied or allowed to sunset in the future. So I think it's important whenever you're looking at tax planning to do planning over multiple years. So it could be enticing to look at this year's taxes and say, how do I reduce this year's taxes the most that I can? But it's important to also include future years and really understand what your marginal and your effective tax rates are today and what they're likely to be in the future. So maybe you find yourself in a position where you think that your income tax rate will go higher in the future. So that could be, you might be in the camp where maybe nothing happens in Congress and the sunset occurs. So your rate is set to go up, or maybe it's just a realization that we are in a very low income tax environment, generally speaking, right now, and in the future could be higher. So a couple things you could consider would be to accelerate income into 24 and 25. Things like Roth conversions, if you have a traditional IRA, or even accelerating a bonus or accelerating some business income into 24 or 25, or even delaying a large charitable contribution into later years where you would get more benefits. So I think our overall comment is that no matter what happens in Congress, whether the sunset occurs or whether it doesn't, or whether we have some sort of negotiation, we've been here before, and there's a playbook to saving taxes in a post-sunset world.
Well, thank you, Jason, for that oversight and explanation. As we think about what lies ahead, we know that many things will continue to change. The leaves of our tree here will continue to evolve. Today, we've touched on tax policy, technology, interest rates, the consumer, the economy, markets. We haven't touched on everything, hoping that we can lean into some more questions here in the Q&A here shortly. The important thing to remember is that as we maintain a grounded perspective, the roots are still there. Those are the parts of the plan that will really allow us to navigate those changes ahead. So let's jump in now to a couple of great questions that we've been receiving. Justin, the first one is for you. If AI requires ever greater amounts of electrical energy, what about the increased demand for energy from Bitcoin? So maybe a little bit about Bitcoin mining and just overall thoughts on the crypto space.
Yeah, I think generally, I don't know how much Bitcoin mining is driving the demand imbalance we have with electricity right now. It's certainly a factor among many other things that are, globally impacting our supply constraints for electricity. But I think generally it is an input cost for, whether it be Bitcoin or whether it be, AI related, topics that we discussed as well. As far as Bitcoin, obviously there's a lot of conversations around cryptocurrencies this year. Certainly the new administration seems to be positive on Bitcoin specifically, but we think back to kind of the advent of cryptocurrencies, and really the excitement at that point was more about, maybe it's a dollar alternative, or the fact that it was, maybe, hoped to be a transaction type currency. And we just really haven't seen that play out. The infrastructure there, the blockchain technology really hasn't been as adopted as it hoped it might be. And so really what it's moved from is, this idea of a dollar alternative to more of an investment. And so at the beginning, maybe the investment was hoped that it would be a diversifier from your core portfolio holdings. And the reality, or even an inflation hedge, and the reality is that hasn't necessarily played out either. If you're certainly thankful to have held Bitcoin over the last year or two, but it wasn't that long ago that we had the period of really, really poor performance, the crypto winter. And so just like any investment for our clients, our recommendation is to know what you own. And Bitcoin has a higher correlation to kind of the tech growthier aspects of the equity markets than it does, a diversifying asset class. And then the other consideration is be aware of how much you own. And so we're obviously not recommending Bitcoin or other cryptocurrencies in Bartlett client portfolios. But if you have an interest in owning it, those are the two considerations that we would recommend you take a deep look at.
Great. Let's move on. John, there's a question here for you. Given the shrinking contribution of manufacturing to overall GDP, should there be a concern about the ability to create real wealth and a concern about the impacts on national security?
Well, I think the short answer is yes, and that's a very astute comment there. U.S. manufacturing probably at its peak was maybe 25% of GDP, and now I believe it's around 10% of GDP. So I've seen statistics where the average in other world economies is about 15%. So if we want to believe that statistic, we're below average compared to other developed economies. I think we saw this most recently during COVID when the lack of manufacturing really left our economy in a much more fragile state. We were overly reliant on foreign manufacturing, and COVID again really brought that out. And I think this lack of our domestic manufacturing can really significantly hinder our ability to produce goods, particularly in times of need. And especially when you look at our defense sector, like you pointed out, it certainly is a concern. So these targeted tariffs, I think that our future administration is talking about can really help drive sustained manufacturing growth in the United States. But I think time will tell whether we can kind of bring that back above that 10% level where we are today. But I certainly would think that revitalizing manufacturing in the U.S. is really essential for continued growth and more importantly for really safeguarding our national security.
John, there's a couple more questions I want to come back to you on the interest rate side. But first, Jason, a question here on how does the market typically prefers split control of government branches. Is the fact that Republicans now have a majority of all branches likely to spook Wall Street?
Yeah, so as I talked about before, so we have a 53 seats on the Republican side in the Senate, and I mentioned a little comment that we don't have 60. So I mentioned that purposely, right? So they don't have enough for a supermajority. So it's kind of tight margins there. And on the House side, I think the margins are even closer there. So I think this concept of being able to drastically change policy across the board in a very easy and without any inertia, I think it's going to be tough for the administration to figure out how to do that. Just imagine if there were a handful of senators who I mentioned, caring about the national debt piece. What if there were a handful of senators on the Republican side who got together and said, hey, we really care about this? That could affect even on the tax side. So I think generally speaking, if you look at the actual numbers over a long period of time, and we have a slide in our deck currently when we're meeting with clients about this, the current situation where we're in, leads itself to positive returns over the long term, regardless of where you are in this mix. Generally speaking, the idea that split between each of them leads itself to this idea of we know what the rules of the game are. And now we really don't know what the future looks like, but we have some tilts. We kind of understand what, maybe it's lower regulation, maybe it's lower taxes. So can we take advantage of that from an investment standpoint and lean into those companies that could benefit from that?
So, Jason, speaking of some of those tilts that we may see coming out of the next administration, John, I want to go back to you on how these potential policies are being viewed in the interest rate market. So we started to see this uptick recently in higher inflation expectations for the long term. The longer term interest rates started to kind of drift back up even before the election. What's your read on that, of what the markets are seeing into it, and how do some of the proposed policy, whether it's tariffs, immigration reform, tax policy, potentially impact the interest rate market?
I think from an interest rate perspective, immigration reform might be the single most important piece of legislation on the agenda. If the incoming administration is successful in the kind of mass deportation, ultimately that means a shrinking labor force. And so you could really see the unemployment rate drop significantly, and you could see inflation really start to take off as companies are competing for workers who are left. So you'll really see that wage inflation piece really pick up if the immigration reform does take note. So immigration reform from an interest rate perspective is probably the biggest thing that we would see. Obviously, tariffs could be an inflationary play there as well, obviously hurting the consumer. And if the consumer ultimately stops spending, then ultimately that could start to limit growth here in our domestic economy.
Justin, there's another question here on AI. Could innovation in AI hardware eventually alleviate some of the high level power consumption that's currently required?
Yeah, I think that's certainly an area of focus for the likes of NVIDIA and the semiconductor design companies who are trying to make their chips more efficient and therefore more expensive as well. This idea of the electricity demand and the strain on our grid is admittedly a topic that we probably could have done a whole section on at a strategy update, and very well may do at some point in the future. But this is an area that is certainly going to have to be addressed, as I discussed earlier. It's not just the tech world that energy is an issue. Certainly that will drive an increase in demand, and if there's not enough supply, that increases prices, if you recall from your Econ 101 class. And so this is a broader issue that we're certainly going to have to overcome. And I mentioned the nuclear plants. That's certainly one avenue. One of the questions that we received in one of our in-person events was just what will this take? What will the eventual energy solution? How will that be solved? Is it going to be one avenue, whether it be solar or wind or nuclear? And the reality is we think it's probably going to be a pretty diversified mix amongst all of those different sources. I think AI is unique in that it requires power 24/7. You and I turn our lights off at the end of every day, and so we don't require as much electricity, whereas the data center, pretty much needs power 24/7. And so we need to be more efficient in how we're deriving the electricity, how we're storing the electricity, and then we're being more efficient in how we use the electricity. So it's different parts between every kind of pivot point, pinch point in the supply chain that will need to be improved upon.
Justin, let's stick with you. One of our questions here is on the idea of small and mid-cap stocks. It's not an area that we touched on a lot, but you started to see some moves post-election in those markets. What are expectations as we look forward in that space?
Yeah, small and mid-cap stocks, certainly we think will benefit from kind of the U.S. first initiatives. Same goes for potentially beneficiaries of increased tariffs, forcing demand for more U.S. based companies. And so generally we love small and mid-cap categories for the diversification benefits that we experience. Same goes for international stocks as well. And the other aspect of small and mids more specifically is that they have a larger proportion of those companies are made up of financial institutions, smaller regional banks, and these types of things. And they're certainly going to benefit from an environment where we see less regulation, deregulatory initiatives. And so those are certainly tailwinds amongst other things for small and mid-cap companies. I'll just touch on international as well. Same thing. We like the diversification benefits that come from international, but valuations are also really attractive internationally, but they have been for some time as well. We just haven't seen, certainly relative to the wonderful earnings we've seen here in the U.S., we haven't seen that play out in the international markets. And so therein lies some of the issues there. So when you think big picture, we're generally recommending to clients an overweight to U.S. large cap size companies and a general underweight to international markets for those reasons. But the diversification benefits are certainly worthwhile.
Great. Well, thank you, Justin, and thank you to Jason and John, our other panelists, for being here with us today. And thank you to all of you for joining us. We encourage you to follow up with your Bartlett team for any more questions as it relates to your particular situation. And we look forward to staying in touch with you. Take care, and thanks for joining us.